Thank you, Mia. Thank you, Abhishek. I'm Kevin Oates, who I'll be in the room all day today introducing the program. As Abhishek said, I mean, last year was a great year in terms of the shipping markets. It looks as if this year may be a good year as well, but the world itself is a troubled place. So we're going to start the kind of the day with we're looking at the macro picture of where we are, where the economies are going, and stuff like this. I'd like to call to the platform, please, Sarah Hewin, who's the head of research Europe and Americas of Standard Chartered Bank, and Sarah is going to give us a presentation on the global outlook for 2024, a soft landing but with risks. Sarah, please.
Thank you very much, Kevin. Thank you, Mia, and welcome, everybody. I always think that it's useful at this time of the year to think about where we've come from over the past 12 months before looking ahead to the next 12 months. When Kevin and I sat on the stage here last January with Tim Power from Drury, US inflation was 6.5%. It was starting to slow down. European inflation, though, was in or near double digits and still very close to the peak. But we had seen a decline from the stratospheric levels of energy prices, food prices that had been driven higher the previous summer. Obviously, 2022 was the year when we saw this very, very sharp moves in commodity prices. But by this time last year, oil prices had fallen below $90 a barrel after peaking at 120 the previous summer. Natural gas prices were well down from the previous summer, although still 4 times the pandemic level. And food prices were on the way down, but still 50% higher than we'd seen before the pandemic. Central banks at that time had recently moderated policy tightening. They'd been raising rates very aggressively when they decided that inflation actually was no longer transitory. We'd seen 75 basis point moves, 50 basis point moves. By this time last year, the Fed was nearly there. It had another 100 basis points of tightening to do. The ECB still had another 200 basis points. ECB had started the tightening cycle later than the Fed. And the Bank of England, which actually kicked off the tightening, was only halfway to where it is now. So where are we now exactly? So inflation has come down, and obviously the feed through from moderating commodity prices, moderating energy prices, some of the energy support that's come out of the market, that has helped to bring inflation down alongside an eventual moderation in food prices. So inflation does seem to be on track now to get back to target, though core inflation is still around 3.5–4%, and it's over 5% in the UK. So we're not quite there yet, and the question is, are we going to see more difficulty getting, that final leg lower compared to the big reductions that we've seen over the past 12 months? The central banks, I think, have been successful so far in tightening policy without crashing the economy. And indeed, what we see for emerging markets this year is a story actually of accelerating growth, with Asia ex-China leading the way. The impact of tight financial conditions is likely to be more noticeable in major markets, where we expect growth to be weaker this year than last. So let's have a sort of deeper dive into what we're looking for in the US and in Europe, and then I'll comment on our China view. So the soft landing seems to apply more to the US than to Europe. The chart here shows consumer confidence, which plummeted, has actually been on a sustained recovery, and that's been helped by improving inflation expectations. Consumers have done better than expected. They've stayed resilient, supported by savings that were built up during the pandemic, but we know that that savings cushion is largely depleted now. Households face high debt servicing costs. We're starting to see a rise in delinquencies, albeit from very low levels, but we have seen quite a sharp rise. And the impact, obviously, of policy tightening affects different sectors of the economy at a different pace. We've seen the housing market. Last year, housing was a drag on GDP through most of the year. We've seen, after a sharp rise in house prices and rents, those are slowing now. And the impact on households and on businesses increasingly is being felt of these tight financial conditions. The last leg to fall is going to be the jobs market. Jobs are still strong across the board, not just in the US, but in Europe as well. But we know that employment is a lagging indicator. It does feel at the moment as if consumer confidence will stay supported as long as the jobs outlook is good. And then as that fades, as we expect a rise in unemployment in the US over the course of this year, consumers will be less willing to spend on big ticket items. So we do see the next few quarters slowing, with more of an impact in the second half of this year than in the first half. Growth for this year overall, 1.8% in the US, but slowing to 1.4%, mostly as a result of weakness in the fourth quarter of this year and the first quarter of next. Europe, I mean, it's a mixed picture. These Purchasing Managers' Indices, surveys of activity for manufacturing and services show manufacturing has been in recession for the past 18 months or so. Services have recently turned down. And for the euro area, we had the latest readings yesterday. It's still looking pretty weak. It may well be that the euro area was in technical recession in the second half of last year, and we see the economy bumping along the bottom for this year. As again, the full impact of policy tightening feeds through. We've seen very weak bank lending. Demand for bank loans has also stayed very soft. The UK is an interesting one because although some elements of the economy are very weak, there seems to have been a small recovery in services activity. Retail sales have been bouncing around, weak at the last reading, but some consumer surveys still show that households are spending. We see the economy here really softening in the second half of this year, but the mix of growth versus inflation remaining more of a headache for the Bank of England than for the ECB and the Fed. Turning to China now, there was optimism that China's abrupt post-COVID reopening would kickstart the economy. And in the end, growth did come in last year above target, 5.2%, but much of that improvement was down to base effects, the comparison with very, very weak year in 2022. And there are lingering signs of distress. We're expecting 4.8% growth for this year, so a slight slowdown. We're perhaps on the more optimistic end of the scale. There are some pretty gloomy predictions out there for Chinese GDP growth. But last year, what we noticed was that forecasts were revised upwards rather than downwards as the year progressed, and consensus moved up to what we were expecting. Now, what could support growth? Well, it's a consumer's willingness to draw on excess savings, but as you can see, consumer confidence is extremely weak. The employment situation is not great. Excess savings, similar to the US and Europe, were built up during the pandemic to a lesser extent, but nevertheless, households still have the ability to draw on those excess savings. Now, there's clearly a drag from the property sector. That drag actually is likely to be less of an impact on growth because it makes up a smaller share of GDP because of the stresses that we've seen in the sector, the decline in activity there. It accounted for 5.8% of GDP in 2023 compared to over 7% in 2019. So the sector we're not expecting is going to be going great guns, far from it, but we think that there will be more forceful policy support which will ease the decline, and there are other sectors of the economy which are clearly doing very well. EVs on the tech sector, production rising quite rapidly. The long-term outlook for China, potential growth we're expecting will slow to about 4% later this decade and 3% by 2035 in the absence of major structural reforms. And of course there are headwinds from demographics. The population, working age population, peaked 10 years ago now at 720 million, and by 2050 it's expected to be 450 million. That's the 20 to 50 age group. Also, a natural slowdown. The economy is maturing, and we're expecting to see slower capital accumulation and flatlining productivity growth. But innovation, decarbonisation remain key themes underpinning the high-quality development that Beijing is striving for. In terms of what all this means for interest rates and what we're expecting over the coming months from the Fed, from the ECB. We have the ECB meeting this afternoon. We're expecting no change. Probably a signal or maybe a confirmation from comments that we had in Davos last week that the first rate cut is coming over the summer months in Europe. It sort of tallies with what the market expectations are. And we know that the ECB is still very cautious about the strength of the labour market. They want to see what's going to be happening to wage growth over the coming months. Wage settlements will be agreed and reached in the coming months, and that will give an indication about whether wage growth stays elevated. For the Fed, again, we're expecting the first rate cut in the second quarter, May or June, and we think that that will be a time when inflation is moving sustainably down to target, when we perhaps will be starting to see signs of the unemployment rate rising, softer economic activity. As things stand, the Fed can sit quite comfortably knowing that the economy is still growing at an above-trend pace, and with some questions over where inflation is going and indeed whether we can get down to that 2% target on a sustainable basis. We're perhaps a little bit more cautious than the market. Market expectations are for about 5 to 6 rate cuts from the Fed and the ECB over the course of the next 12, by the end of this year. We see 100 basis points, so 4 rate cuts from the Fed, from the ECB, and actually from the Bank of England as well, although we don't expect Bank of England cuts to start until the third quarter. So what might the risks be around this view? Well, jobs, as I've said, the jobs market is very strong. You can see unemployment rates at or near all-time lows for the US and the euro area. And that means that wage growth is still solid. Wages growing at around 4% per annum in the US, 4 to 6% per annum in the euro area. That means that services inflation is falling at a slower pace. So the chart on the right-hand side shows that you still have services inflation running at around 4% in the US and Europe, and then over 6% in the UK. So we think that this will be one reason for being cautious about the further improvement in inflation. The second reason for caution is, of course, disinflationary factors are fading. Commodity prices have been a drag on headline inflation, so year on year commodity prices, energy prices in particular, have been falling. The chart here shows a sort of nice dip below zero for much of last year. That is now starting to fade, so we're sort of broadly flat year on year with energy prices, with a upside risk, of course, down to geopolitics. Freight costs, I don't need to tell this room what's happening there, but that was a huge disinflationary impact through late 2022 into 2023, and that has reversed now. What about oil prices? At Standard Chartered, we have a slightly different view from consensus on the outlook for oil prices. We do see prices rising steadily over the next couple of years. A number of reasons there. We think that there's very little geopolitical risk priced in at the current price, given the number, scale, and complexity of geopolitical issues. If we think about, obviously, increased risk to oil, Russian oil, including loadings in the Baltics, military action in the Red Sea, uncertainty regarding Iranian foreign policy. On the demand side as well, we think that very immediately there's a lot of trader bearishness on the oil fundamentals, which it may be misinterpreting seasonality factors. Normally at this time of the year, there would be seasonal oversupply, and we think that that's likely to tighten significantly from late January. Now, that's a sort of demand-supply type of backdrop, which we think would support oil prices higher. And of course, we have the broader geopolitical concerns that are facing the world. So I'll tie up by talking about geopolitics and politics. So the slide here, I mean, obviously we've started the year with geopolitics very dominant in the middle of a Middle East crisis that's already disrupting global supply routes and is raising questions about how quickly central banks can indeed ease policy. So, I mean, in terms of the sort of risks, these have been widely discussed, so I won't spend too much time on them, but obviously, the key question is on shipping lanes. How long do Houthi attacks last with the inflationary impact that brings? We know that there have been IMF estimates that when global shipping costs double, headline inflation can rise by 0.7 percentage points. And certainly, we've seen at least a 50% rise in freight costs. The risk is that the attacks disrupt oil deliveries or that the conflict draws in oil-producing countries. And of course, if the US were to take a more hawkish approach to Iran, that could make a difference to the extent to which Iran was able to export oil and ship oil to the global market. From a political point of view, I'm sure that's not something that Joe Biden will want to see with the election at the end of this year. The aim from the US point of view would be certainly to keep gasoline prices as low as possible. But there at some point may be a trade-off if attacks intensify and oil prices are driven higher in any event, alongside the impact that we're already seeing on other goods prices. Our own view is that Iran certainly doesn't want to escalate the situation. The US doesn't want to, despite all the noise. Similarly, Hezbollah, we have seen increased activity from Hezbollah, but we don't expect that that's going to escalate. There is a concern that in Tel Aviv, the Israeli leadership has concerns about Lebanon. If the war extends into Lebanon and Hezbollah is seen as an unacceptable threat, then that could be an escalation which brings in other parties. Saudi Arabia will play a key role. They hold some leverage, but the two-state solution, which Saudi would want to promote, is falling on relatively unfertile ground. The second geopolitical risk, of course, is that we face the biggest election year, I think in history, but certainly in recent history. So half the world's population is going to the polls this year. 8 out of 10 of the most populous countries. Taiwan obviously has already held its election. The outcome, neither as sort of favorable as could be hoped for, nor unfavorable for global geopolitics, with DPP's William Lai beating the pro-China KMT, but KMT winning the legislative elections. So Lai, with weak parliamentary support, has no strong mandate and is unlikely to push for a referendum on Taiwan's sovereignty. So other elections coming up, we have Indonesia on the 14th of February, Korea on the 10th of April, and shifts there could challenge the sort of fragile geopolitical situation across the region. South Africa in May, India, April and May. Modi, according to the polls, is looking highly likely to be re-elected, so no major policy changes expected there. And then, of course, the big one for the West is the US election in November. Donald Trump increasingly likely to be the Republican nominee, and polls suggesting that he is at least neck and neck with Biden, some polls showing him ahead. Of course, it's all going to be down to the swing states, and we don't really have granular polls at the moment that will indicate, how far those swing states are likely to support a Trump presidency rather than the status quo. As we go closer, once we get past Super Tuesday from March, we will start to get more information about what sentiment is in those swing states, which will make all the difference to the outcome. And of course, Donald Trump faces a huge legal headache. We'll spend a lot of this year in court. And the question is, again, how far does that shift the balance for the independent, middle-of-the-line voter? We know and we can see from, we can understand that his own supporters very much find the legal challenges a strong reason to support him. That may be less the case for the moderate voter. So with all of those thoughts in mind, the soft landing, we still see that as likely, particularly for emerging economies. The risks, I think, are very clear. The risks are inflation. The improvement in inflation is slow or possibly even reverses. Central banks no longer feel able to ease policy lower. The talk about cutting rates starts to be pushed back until later this year, would be a risk. And the big geopolitical risks that we've discussed, particularly for the Middle East region, but a number of other pinch points as well. Thank you very much.